Welcome, everyone, to our on-demand training for understanding federal employee life insurance. On behalf of Serving Those Who Serve, whether you're joining us for the first time or you're a returning federal employee, we're glad you're here. My name is Dan Sipe, and if you don't know me, I'm actually the founder of Serving Those Who Serve, and we are a federal benefits education and fiduciary financial planning group with the unique mission to reach, teach, and serve you, the career civilian Fed. Now, I want to begin, as I always do, by saying thank you. Thank you for your service to the government, to the country, to me, to everyone. You do not hear that enough, but you will always hear it here. Now, I know right now you're watching this on your schedule. So I don't know if it's morning, evening, weekend. I'm just happy that you're here. But that's exactly why we created this format. The biggest thing we learned from last year is that your work environment changed, and finding time during the workday for professional development has become increasingly challenging. So we've made this valuable training available to you whenever and wherever it works best, whether that's evening hours, weekend time, or in segments that fit in your day. Now, for this training, we do have a constant, and that is Ed Zerndorfer presenting. If you don't know Ed, he is a retired career Fed himself and probably has more certifications than anyone we've ever encountered. He is also, hands down, the most published author currently writing about federal benefits. You've no doubt read his work in Fed Soup, federalnewsradio.com, My Federal Retirement, Federal News Network, and perhaps most importantly for us, right here in the Fed Zone. That's fed-zone.com. Quite simply, in my opinion, no one knows these topics any better. Before we get started, I want to take a quick moment to talk about the model for this training because it's likely different from other video on demand things you've encountered. So what you're experiencing right now is what we call part one, which is general education delivered in this on demand format. We also have part two, which is personalized education. And that is delivered via Zoom at a time that works with your schedule. Why? Well, we found that over the years, people will attend multiple webinars, seminars, lunch and learns, trainings, you name it, and still don't completely understand how their benefits will behave and personally impact them or their families. So part two was created to ensure that you get your specific questions answered and have that deep and personalized understanding without pitches, pressure, or obligation. And that part is key. Because part two is personalized to you and your family's unique situation, we offer it by appointment only. So throughout today's training, you will see QR codes pop up on the various slides. If at any point in time you'd like to schedule a part two with us, simply use the camera on your cell phone, scan that QR code. This will open a scheduling page where you can select a great date and time, and we look forward to talking to you. Now, if you happen to be choosing to view this from your cell phone and therefore can't access the camera feature at that moment, try this. Take a screenshot of any one of the slides, then open the picture under your Photos app, tap and hold down that QR code. That should open the scheduling page. If you're not a QR code person, that's okay. You can always email us directly at part2@stwserve.com to request that session. So here's how this on-demand session works. Ed will present the comprehensive training content. Throughout the presentation, you will see examples of questions that we typically address in our part two sessions. And in these types of sessions, when they're live, while you won't be able to ask the questions in real time as you would in the live webinar, you can always email your specific questions to part2@stwserve.com or schedule a part two session where we can address everything that's unique to your situation. Next, in keeping with our mission and the interest of full disclosure, Raymond James asked us to provide the following slides, and we are happy to do so. I do want to highlight a couple of things. Number one, Serving Those Who Serve sponsors this educational session to bring Ed to you. Number two, Ed is not here to solicit. Never, never. And today will be purely educational. And number three, and lastly, we are not a part of OPM. I'll be back a little bit later to talk about the whole process, but without any further ado, let me introduce you to Ed. He's been helping federal employees have a better understanding and make better retirement federal benefits decisions for over 25 years. Now, I told you he has a ton of certifications, and here they come. He is a certified financial planner, a chartered life underwriter, a chartered financial consultant, a certified employee benefits specialist, an enrolled agent, and like all of our advisors here at Serving Those Who Serve, he's a chartered federal employee benefits consultant. Ed is also a member of the Maryland Society of Accountants, the National Association of Enrolled Agents, the International Society of Certified Employee Benefits Specialists, Financial Planning Association, National Association of Health Underwriters, and the Society of Financial Service Professionals. I told you he writes, boy, howdy does he. He does it every single week for us in the Fed Zone, as well as for My Federal Retirement. And he is my go-to featured guest on our FedLife podcasts. You can find those on YouTube at FedLife. So without any further ado, I'm going to turn it over to Ed. Take it away, sir.
And hello, everyone. Thanks for joining us. We're glad you had this opportunity to view this particular webinar on understanding your federal life insurance benefits. Before I get started, I'd like to thank Dan and all the people at Serving Those Who Serve for once again giving me this opportunity to do another webinar. I couldn't do this webinar as well as all the other webinars we present here at Serving Those Who Serve without Dan and the people at Serving Those Who Serve. And I'd like to thank them because again, we're doing this for the federal employee, for federal retiree community, so they can better understand their benefits. And it's a pleasure presenting this particular one on life insurance benefits. Before we actually get started, I have some websites here I'd like to show here, up here on the screen. The first bullet, www.opm.gov, healthcare insurance, life insurance. That's on that particular site. You can get all the information concerning the Federal Employees Group Life Insurance. The Federal Employees Group Life Insurance is a group-sponsored, the sponsors of federal government life insurance program for federal employees and retirees. We're going to be talking a lot about FEGLI today, as well as other types of life insurance that's available to federal individuals, federal employees, and retirees. The next bullet, www.fed-zone.com. As Dan mentioned, I write a weekly column for Serving Those Who Serve. It's called the Fed Zone. I write one column a week, every week of the month, every month of the year, on average about 50 to 60 columns on what topics? Employee benefits. I write columns on CSRS. I write columns on FERS. I write columns on Social Security. I've written many columns on the TSB. I've written columns on all the employee insurance benefits, including the federal employee health benefits and Medicare, dental and vision insurance, life insurance, long-term care insurance. I write columns on tax planning for retirement, survivor benefits, and estate planning. You name it, I write about it. I've been writing these columns ever since April 2019, almost will be about almost 7 years, almost be 7 years in April. And every column I've written in the Fed Zone has been archived. If you have a particular subject you'd like to read about, like life insurance, all you have to do is to go to www.fed-zone.com. Under the search engine, put your favorite topic, life insurance, TSP, anything. And every column I've written over the past a little over 6.5 years will pop up. I want to emphasize the fact that the way I write my columns is that you understand them. Nothing high-powered, down-to-earth, good information. Ladies and gentlemen, a lot of your questions about your benefits can be answered just by reading my Fed Zone columns. Let's be very honest with one another. If you're an employee and you go to your human resources or personal office, you have questions about your benefits, some of the questions you ask them, personnel cannot answer or HR cannot answer, they will not answer or should not answer. I'll give you an example. You may have questions about life insurance. Where should I get life insurance? Where's the best place to get life insurance? How much life insurance should I own? They're not licensed insurance people. They're not allowed to answer those type of questions. You may have questions about the TSB. You may have questions about tax planning. Again, they're not licensed to answer those type of questions. Another problem is that even if they could answer these questions, they're so overwhelmed. They've been cut back. You have a problem, get your questions answered. Now you do have a place to get those questions answered. It's called the Fed Zone. And if you're a retiree, ditto. If you have questions about your retirement benefits, I would not call OPM because they're not going to answer your questions on the phone. You may have questions about the TSB. They're also overwhelmed. They're not going to answer questions about TSB. And then even Social Security. Try calling the Social Security Administration. You're going to be put on the phone. You're going to be waiting on the phone for anywhere 3 to 6 hours if anybody gets to you. you also have a place to get your questions answered about your retirement benefits. It's called the FedZone, so please take advantage of it. And the last bullet there, www.stwserv.com. Among the things on that website, well, you signed up for this webinar. Or I should say, you saw this webinar advertised on the site there. We also have some live webinars that you can sign up for. They're free. You can attend as many times as you want. The more you attend, the more you're going to learn. Also on the website there are blogs. Others serving those representatives write blogs on employee benefits on the website there. Well written. You can learn a lot about your benefits just by reading those blogs. And finally, our podcast. As Dan mentioned, he and I do a monthly podcast in which, for an hour, hour and a half, we review my recent FedZone columns. We talk about them. He goes, there's a question and answer, sir. You can learn a lot about your employee benefits by listening to podcasts. We have done podcasts on life insurance. You can learn a lot just by listening to podcasts at your leisure. There's over 100 podcasts out there, and there are other serving representatives. I know Caitlin, Dan also do a podcast on a regular basis. So again, you can learn a lot by listening to their podcasts. Ladies and gentlemen, I want to make a point here. There is a tremendous amount of information out there on the Serving Those Who Serve website. Besides the webinars, the blogs, the podcasts, we are here to educate. We're here to answer your questions. And again, we're not out to sell, we're out to educate. So please take advantage of it. And with that, let's go ahead and start talking about life insurance. This past September, I wrote 4 FedZone columns on life insurance. Why? Because September is Life Insurance Awareness Month. And I did that because it was very timely. Every September, individuals are reminded to think about how their life insurance, that they need life insurance, where to get life insurance. So I wrote a series of columns. So if you go to the FedZone and just go to www.fd-zone.com, you can, and you click on the search engine, put life insurance, and all my columns I've written on FEGLI will pop up. The most recent ones were written, as I say, in September. Okay. All right. Why should someone purchase a life insurance policy? Why would someone want to have a life insurance policy? I'm going to give you some possible reasons here. Life insurance is the foundation of a sound financial plan. How so? A life insurance policy has a potential high yield and a tax-favored benefit. Now, what do I mean by a high yield? And the best way to explain, and tax-favored benefit, the best way to explain that is to give an example. Now, I am licensed. I have a life health insurance license. I do not sell life insurance policies. I have my license mainly so I can talk about life insurance and what individuals should know when they buy a life insurance policy. Now, when I did sell life insurance, I'm going to give an example of a high yield, a potential high yield and a tax-favored benefit. So this goes back probably about 25, 30 years ago. I had an individual who had just bought his first house, a married person married and has 2 children. And he came to me, got my name from someone, says, I just bought a house. I have a $300,000 mortgage, and I have a family, a growing family. And it's my understanding that I need to increase my life insurance. I have a little bit of life insurance, but now I think I'm going to need more. And I said, you're right, because you want to make sure that all your debts any debts you have, significant debts like the mortgage, are paid off when you pass away. Life insurance is a good way to pay off potential debts without burdening, your survivors with payments on the mortgage. All right. So here's what happened. He qualified. We figured out how much life insurance he needed. He qualified for a $500,000 term, meaning no cash value, a strict death benefit, $500,000 life insurance policy. And his premiums, he was in good health, his premiums were $1,000 a year. $1,000 a year. He was in his mid-30s, so he was fairly young and healthy. So he qualified to get a good rate, $1,000 a year for a $500,000 policy. And he wanted to know a little more details about how this works. And I said, well, if you qualify for this policy, you as the policy owner, you only have one obligation. He said, what's that? To pay the $1,000 a year, $1,000 a year. And if you do, and God forbid, you were to pass away within the 30-year period, that's when the life insurance policy will be used. For 30 years, he's going to pay for 30 years the same amount, $1,000 a year. It's called a level term life insurance policy. That your beneficiary, most probably your spouse, will receive a check for $500,000 and it's tax-free. He said, wow, $1,000 a year and then if I were to die anytime after that policy takes effect, my family gets a $500,000 tax-free benefit. Wow. That is a good deal. That is a good deal. So, but I'm the first to tell you though, that not everybody needs a life insurance policy. There has to be a reason. Let me give you an example of some reasons. Look at the second line. It says provides for family income needs. Life insurance, one of the main purposes of buying a life insurance policy is that if someone is working and they're providing for their family, the question comes up, what were to happen if that individual were to die? No more paychecks are coming in. How would the family survive? It's called life insurance. But that's one of the primary reasons why individuals buy life insurance, to provide for a family's income needs if the person were to pass away. But don't get me wrong, just because you're not working does not mean you do not need a life insurance policy. You have value. We'll give you another example. And this example goes back to about, almost 30 years ago. I got a phone call. I was doing live seminars for federal employees. So I was doing a 2-day retirement seminar, or it was actually a mid-career seminar for a federal agency. So after I finished the seminar, a gentleman comes up to me after the seminar. He says, I think I have to get some life insurance. He gave us all the reasons why one needs life insurance. Would it be possible for you to come out to my house, sit down with me and go over my life insurance needs? I said, okay. I normally prefer not to, take on clients from classes, but since you initiated it, I will make an exception. So I went out to his house. We sat down at his kitchen table, and I had my pad out and my calculator, and I said, "Tell me about yourself. How much you're earning? Tell me about the rest of your family." He said, "I have a wife. I'm 27 years old. My wife is 24. I have 2 small children. One child is age 3, another is age 1, and so on." So after all was said and done, I figured out, after knowing also how much his mortgage is, that he needed about an $800,000 life insurance. And he was very satisfied with that for 30 years, because that was the term of marriage. But we're all done. I said to him, "What about your wife? What about your wife? What about her needs for life insurance?" So he said to me, "Oh, she does need life insurance. She's not working." I said, "Excuse me? Your wife's not working? While we're having this conversation, she's chasing the 2 small kids around the house." I said, "Sir, you don't want to even think about it. If God forbid she were to die, who's going to take care of your children? Her daycare, things like that." He said, "I never thought about that." Here's the bottom line. We got her a $200,000 life insurance policy. You cannot put a dollar value on a stay-at-home dad or mom. You don't even think about it. So that's where life insurance will come into play. You'll never replace someone terms of the monetary value. You can't put a dollar sign on what the value of a stay-at-home dad or mom is, but it definitely will help to have a decent amount of life insurance. And the other reason someone would want to have life insurance is to pay off a large debt, such as a mortgage. If someone purchases a house, a condominium, any type of real estate, and they don't have cash to pay for the whole, to have enough sufficient cash to pay for the whole thing, they take out a mortgage and they pay back the mortgage. Well, if the person passes away, whatever's left on the mortgage is not going to be forgiven. Therefore, what financial planners recommend is that when you take on a mortgage, ideally, you'll have enough life insurance to pay off the mortgage in case you pass away before the mortgage is paid off. If you buy a 30-year mortgage, if you're getting a 30-year mortgage, you buy a 30-year, you get a sufficient amount of life insurance to cover you during that 30-year period. Let's say a 30-year term. If you get a 20-year mortgage, a 20-year term. 15 years, same thing, to pay off the mortgage in case you pass away. Other reasons to purchase life insurance: to create an instant estate at the death of policy owner. Now, I always say this, I don't want to be blunt, but you don't buy life insurance to make somebody rich. Maybe you want to help family members when you pass away. Some family members, I'm not talking about necessarily children. Maybe you have siblings, or maybe you have distant relatives who are really not in good shape, and they would need this. They could use this money in case that you were to pass away. And you give them gifts throughout time to help them, maybe donations, things like that. Well, the life insurance paid out would help them, help sustain them after you pass away. Another reason why people buy life insurance is to help pay death taxes. We're talking about estate inheritance taxes, estate settlement costs. I don't know if you've seen these commercials on TV that her mom is in a assisted living facility, and she tells the children, "Oh, I bought a life insurance policy." And the children say, "What? How could you afford a life insurance policy? And for how much?" It's, "Oh, it was not much. It was like $10,000, $20,000. And all this is that a funeral home, it's a contract with with an insurance company that the insurance company issues a life insurance policy. It's guaranteed issue. You don't have to qualify for it. And at the death of the individual, the life insurance proceeds will help pay for the funeral. As I say, it's guaranteed issue. It's not much. These are really basically whole life policies. And because they're not much, the cost is not all that bad. I think you have to buy it before, I think you're 75, something like that. All right. So these are some of the reasons people buy life insurance. That being said, if you're a federal employee, what are your choices when it comes to life insurance? It comes down to two types of policies, and they can be further broken down to other types. Well, let's get to the basic here. The basic types of life insurance are group life insurance policies, an example of which is, this is an employer-sponsored life insurance policy. An example is the federal employee group life insurance. Again, an employer sponsors this policy in which permanent employees, in this case, permanent employees of the federal government, whether you work full-time or part-time, are eligible to join. In fact, when you entered federal service, when you came into federal service, you were automatically enrolled in FEGLI. And we'll show you a little bit later, we're going to show you which part you were automatically enrolled in. At what is called guaranteed issue. You didn't have to furnish evidence of insurability. That means you didn't have to go through a medical exam. That's one of the advantages of a group life insurance policy. That the employer sponsors it, and uses an insurance company that takes care of all the policies, the applications, things like in terms of taking care of all the paperwork, so to speak, when it comes to issuing these policies. And when employee comes to the federal service, they're automatically enrolled in it. No medical exam. That's a real advantage, because we're going to talk next about individual life insurance policies, in which an individual, let's say an employee, the federal government, doesn't want to go into the group, into the FEGLI. They have a life insurance policy that they purchased from an individual life insurance company. There's no lack of companies out there. But in order to get that policy, the individual had to qualify for it. They had to go through a medical exam. In some cases, their medical records will definitely be checked, and there is a chance that the insurance company will turn them down, will reject them for one reason or another from getting this life insurance policy. That is not the case with a group policy. Now, there's another difference. There's another difference between the group and the individual. If an individual is in very good health, super good health, no history of heart disease, that has not smoked, they don't participate in dangerous activities like hang gliding and things like that, those types of occupations that can be very hazardous, then they may qualify for what is called super premium rates. That is not the case with the group policy. With the group policy, whether you are the picture of health or you had some significant health problems, with FEGLI, you are in. There's going to be no better rate if you're a non-smoker. You're not going to get a better premium rate, insurance rate, than if you are in super great health. Everybody pays is basically the same amount given their age and given the amount of their salary, as we'll see later on. And lastly, life insurance policies can be broken down to two types: term life insurance versus permanent cash-value life insurance. With a term life insurance policy, you are buying a death benefit only. There's no cash buildup. With a permanent policy, now let me get back to term one second with term. Term has a limited life. Term life insurance policies, if you go to the private market, they can be issued for 10 years, 15 years, 20 years, 25 years, 30 years. I understand some companies now offering 40 years. And what happens after the term is up? No more life insurance. With a permanent cash life insurance policy, the policies will go on forever, provided the policy owner pays the premiums. In addition, the premiums are higher because part of your premium dollar is being invested. We'll see the different type of permanent policies later on. The premiums are going to be higher, and sometimes permanent cash value life insurance may not be appropriate. All right. So let's review here what we said about the advantages of term life insurance. The advantage of term insurance is that the initial premiums are generally lower than permanent insurance policy. And what does that mean? It means it allows the insurer to buy a larger face amount of insurance. Now, when you think about that, when do most people have a need for life insurance? Think about this. At what point of their lives would they need to have a larger amount of life insurance? I would say when someone, let's say, is on the younger side, let's say mid to late 20s, maybe they bought their first piece of real estate, took on a mortgage, they got married, have children, which will be, let's say, late 20s or 30s, is probably a time that most people need that larger amount of life insurance. Well, by buying that life insurance, that term life insurance policy in their mid to late 20s, early 30s, it's going to cost, in terms of premiums, a significant amount of money less. I said their premiums will be much less compared to if they bought it, let's say, when they are in their early to mid 40s. And then it gets even worse after age 50. Okay? So, again, the need for protection typically is greater at a younger age. If you buy, let's say, a 30-year term policy, in your mid to late 20s, early 30s, and you take on a 30-year mortgage and you have children, by the time you reach your early 60s, the mortgage will be paid off, hopefully. Your youngest child will hopefully be on his or her own, and it's just you and the missus, and now you're bringing in you have retirement income coming in. Pretty soon you'll be on Social Security. At that point, you may not need the life insurance, and that's where term insurance makes sense. Again, term life insurance is appropriate for covering needs that will disappear over time, such as paying off a debt, including a mortgage loan, even a car loan. I say car loan because in this, I read an article that now, with the skyrocketing costs of cars, both used cars and new cars, individuals are taking on 10-year car loans, 10-year car loans in order to be able to afford the monthly payments. Were people buying life insurance policies to cover car loans when they were, let's say 5-year? Yeah, but they still had when it comes to term life insurance, the insurance companies will not offer anything less than 10-year term, 10-year, 15-year. So now, maybe when you have a car loan, that's why individuals are buying life insurance policies in order to pay off their car loan should they die within the 10-year period. The disadvantage of term and life insurance: the premiums usually increase as the insurer gets older, unless a level term policy is purchased. We're going to be talking about the different types of term policy. And I will tell you my recommendation for buying term life insurance. And this is when I was selling life insurance for years. I was selling life insurance for probably 20, 30 years. I would always recommend to clients that they buy a level term life insurance. What does level term mean? It means that when you buy the policy, the premium you pay will stay the same throughout the term of the policy. It could be a 10-year level term. It could be a 15-year level term. It could be 20, 25, 30, 40-year level term policy. You pay the same premium. Now, that premium might be a little higher compared to buy another type of term life insurance policy, and we're going to go through the different types of term policies a little bit later. But there's another one that's very popular, and that's called annual renewable term life insurance, in which your rates will probably go up each year as you get older, and we'll explain why. Another disadvantage of term life insurance is the coverage terminates at the end of the term. That, once the term is up, whether it's 10-year, 15, 20, 25, 30 years, the policy's up. Well, what's the problem there? Is well, if you bought a 30-year term policy, you bought a 30-year term life insurance policy, let's say, like I was saying a few moments ago, when you are in your late 20s, early 30s, because you have a 30-year term mortgage, the idea being that after 30 years, the mortgage will be paid off, you don't need life insurance. Makes sense, right? Well, what happens if you refinance the mortgage? 10 years into your mortgage, rates came down, and now you're taking out a 20-year term policy, which is going to extend beyond the end of the original life insurance policy. After 30 years, the policy's up. Let's say you got 10 years left on your mortgage. You got to think about that. And the idea is that you have to go out and get another term life insurance policy in order to cover the mortgage while you are paying off the refinance mortgage. The idea being, just because you bought it when you were in your 20s doesn't mean you're done. Things may change. I mean, necessitate you buying another term policy. Okay, and you also have to keep in mind that now, let's say my example here, if you got your original mortgage when you were 30 years old, go for 30 years, and 10 years later you're 40, you're gonna extend that mortgage for another 10 years. You're sort of taking out a new mortgage. You're older. Your premiums are going to be higher. You may not be able to qualify. Maybe you have some health issues at that point. Or if you do qualify, you might be what's called rated. Your premiums will be higher. Okay. And another disadvantage of term life insurance, as they say, the policy does not offer any cash value or paid up insurance. So individuals say, why do I need to buy, what's the good of buying this thing if I had nothing to show for it when it comes to at the end of the policy? Well, my argument is that the idea of insurance in general is you're paying a relatively small amount of money called premiums to protect yourself against a financial catastrophe. If you don't need it, great. You outlive the policy. That's fine. That's fine. That's fine. You should be very happy you outlived the policy. So that's some of the disadvantages of term life insurance. Permanent cash value insurance provides lifetime protection designed and priced so insured can keep the policy over a longer period of time. And here are the different types of permanent life insurance policies: ordinary life, universal life, adjustable life, variable universal life. I'm not going to get into the details of these policies. I personally am not a big fan of cash value life insurance for one simple reason. That my feeling is that life insurance should, the purpose of life insurance is, again, for protection. Okay. It should not be an investment. There are ways you can invest your money better than through life insurance. And unfortunately, through the years, many of these cash value life insurance policies, particularly the ones that have variable life, variable universal life, unfortunately have been sold to individuals. People don't buy these things. They're sold on something, and that's not a good idea. When it comes to investments, I've always told my clients, and I have an accounting and tax practice, and I tell my clients when they ask me questions, is this a good investment? Is that a good investment? And I say, I'm not licensed to give you an answer. But I will tell you this. When it comes to investing your money, never invest in anything in which you don't understand what the nature of the investment is, how your money's being invested. And unfortunately, most people do not understand how these cash value life insurance policies, particularly the ones that are invested in the stock market, work. So I recommend that they hold off and when they buy these things, before they buy these things. All right. How much life insurance? As a question comes up, how much life insurance does an individual need? This is a question that comes up so often when I used to have clients. How much life insurance I need? Well, through the years, there have been several studies trying to figure out how much the average person needs in life insurance, and they're listed here. And these methods include multiple of income. What does that mean? Take your salary. I'll give an example. Take your salary, annual salary. Somebody's applying for life insurance policy. The insurance agent, the insurance broker says, how much is your salary? $100,000 a year. 8 times that should be okay. 8 times 100,000, you enter $800,000 of life insurance. To me, that's too simple. Capital needs analysis, human life value. Each method, let's look at it to explain better. What it says here, the multiple income method for determining life insurance needs. The simplest method for estimating your client's life insurance needs is the multiple of income approach. The goal of this approach is to replace the primary breadwinner's salary for a predetermined number of years. Begin by multiplying the client's current annual income by how many years they want to provide financial support for their survivors. The recommendation is to have 7 to 10 years of life insurance. It's an easy method for life insurance analysis, but it doesn't take into account the specific needs of survivors, current assets, and existing funds, such as the survivor's income, investments, or different types of life insurance. This method may not work well for a family of one child, but it may work well for a family of one child, but might not work as well for a family of 6 children. Okay? For example, this method may work well for a family with one child, but might not work as well for a family with 6 children, especially if you want to send off 6 to college. It also doesn't take into account inflation or future salary increases. Using the multiple income method for life insurance assessment may lead to overinsuring or underinsuring your clients. This calculation also does not account for inflation or changing market conditions. All right, here's the capital needs analysis. You can see it's quite detailed. It's quite detailed. To me, this is a better. I'm not going to go through the whole thing here. It's a better way. It's a better way of assessing one's need for life insurance, as is the human life value. My opinion, if you need life insurance and you want to contact a licensed insurance agent or insurance broker, I would make that person go through all this analysis. Don't if you want that person to really sell you a policy that you need, make the individual earn it. Earn it. A life insurance broker will only get paid if they sell you a policy. They sell you a policy. In my opinion, that person should earn their salary by doing a detailed approach. To me, the multiple of income is too simple. This human life, and the person should be familiar with this. They get out their calculators and start grinding the numbers to see how much life insurance is you need, given your family size, given your salary, more amount of mortgage, how many kids you have. May have other family members that have a need, et cetera, make them earn their commission. All right, let's get started on the FEGLI life insurance program, and then we will we'll get some questions in here based on so far what we have discussed. All right, the Federal Employee Group Life Insurance Program, FEGLI. It's available to permanent employees, full-time or part-time, but you got to be a permanent employee. If you're a temporary employee, federal government, you're not eligible for FEGLI coverage. If you're a retiree, can you have FEGLI? Yeah, but you must have had it. We'll see later on how retirees qualify to keep the FEGLI in retirement. It's term life insurance, no cash value. It's not level term life insurance. The premiums for FEGLI generally increase as the employee ages and the employee's salary increases. It's available to full-time and part-time. It's voluntary employees. It's voluntary. Employees pay 2/3 of the premium cost for what's called the FEGLI basic coverage. There are different parts to FEGLI. The first part to FEGLI is called the FEGLI basic insurance amount. FEGLI basic insurance amount. What is the FEGLI basic insurance amount? It is your current year SF50 salary. If you go to your standard form 50, notice a personal action. There are a lot of boxes on there. If you go to box 12C or 27C, depending on the nature of your SFC, it's going to say adjusted basic pay. What is your adjusted basic pay? It's your whatever pay scale you're in, whether you're a GS 13, step 2, whatever that salary is, plus any locality pay adjustment. That is your salary. That is your basic salary, adjusted basic pay, I should say. And your FEGLI basic insurance amount in a given year is the amount of that amount in box 12C or 27C, rounded up to the next $1,000 plus $2,000. That's called the FEGLI basic coverage. And then there are the additional coverages, which we'll go over here in a few moments, what they are. Most employees are eligible to enroll when they are hired with no medical exam required. Note again, it's called guaranteed issue. Okay. FEGLI also offers optional coverages. Option A, standard, $10,000. Option B, multiple current SF50 salary. That's 1 to 5 times. And option C, family coverage for spouse and children. Now, when you came to the federal government, as I say, you were automatically enrolled in the FEGLI basic insurance amount. And if you didn't want it, you had to formally get out of it. Then, when you were hired, you had 60 days to enroll in the optional coverages. The optional coverages. And if you didn't enroll involuntarily during the 60-day period, you didn't get it. If you turned down FEGLI when you came in, you didn't enroll in the optional coverage, and you didn't enroll in the optional coverages, can you get into it? Yeah. And we'll see later on when you can get into it. Basic life insurance, okay. What does the premium cost? Let's see what it says here. The premium cost for the FEGLI Basic is 16 cents per $1,000 of life insurance coverage. This is your FEGLI Basic insurance amount per pay date. Since there are 26 pay dates per year, if you multiply 26 pay dates per year times 16 cents per $1,000 of coverage, the cost for FEGLI Basic insurance amount is $4.16 per $1,000 of life insurance. That's per year. Since there are 26 pay dates, you divide 26 pay dates by $4.16. The cost for the FEGLI Basic insurance amount is 0.3467 cents per $1,000 of coverage per month. Now, I want to keep that figure in mind, because we're talking about when you are an employee, that is the cost. We're going to see later on what the cost will be if you decide to keep your FEGLI Basic in retirement. Okay? All right. Okay. So, all right. I think it's time now for questions. So let's have some questions now, Dan, as we have up here on the screen.
Folks, I want to pause briefly here to share some examples of questions that we often hear at this point in the training. These are exactly the types of questions we address in our Part 2 personalized education sessions. Remember, you can scan the QR code at any time to schedule your Part 2, or again, email us at part2@swserve.com. But first, I'd like to tell you a little bit more about the Part 2 process we mentioned a couple of times. So Part 2 came about as a result of our observation over the years here at Serving Those Who Serve that people come into trainings with questions like, what is it and how does it work? Well, then the information starts flowing. And then those questions morph into, what's mine going to look like? And how is that going to affect me and my family? And that is exactly why we created Part 2. So Part 2 is personalized education, and the focus is on education. It consists of 2 complimentary, no-obligation meetings with one of the advisors of Serving Those Who Serve to review your benefits. So today, we're learning about insurance, but we believe no retirement decision exists in a vacuum. All of these parts can influence your retirement. So we are going to discuss everything. And to do so, we're going to create a comprehensive report for you covering all of your retirement benefits. So the first meeting is data gathering. We're going to ask you to bring some information. Then at that second meeting, we're going to review with you in detail that benefits report. So obviously, we'll do some pension projections, but we'll also talk about Social Security, TSP, health insurance, Medicare, survivor benefits, and of course, life insurance, all included in the report. What I'd like to do here, though, is a little compare and contrast between the report that you are used to from your HR and the one that we offer. Those HR reports are fantastic, incredibly accurate. But one of the things I've noticed is they only show the first year of retirement. And I haven't met anybody that only plans on being retired for 1 year. So by contrast, our report goes much further, actually until age 90. And we'll also give you multiple scenarios for different retirement dates as well, while we project out a longer term what your retirement might look like. In addition, with regards to Social Security, some of your HR reports will give you sort of a summary. And yes, you can always log into ssa.gov to track down some more information. But our report is going to bring Social Security and your pension together and also show you what future cost of living adjustments might look like. And that is really important. So to sum up, yes, we'll talk about FEGLI and insurance, but also your pension, survivor benefits, health insurance, TSP, Folks always have a ton of questions about TSP, traditional TSP, Roth TSP, Roth conversions. That's going to be a big topic this year. How do I get my money out of TSP? Those are all the things we can talk about in these meetings. And again, there's no obligation. Ed and I encourage people to take advantage of this. We've never met anybody who said they didn't learn something from a part two. And best of all, the meetings are held over Zoom, so you don't even have to go anywhere. You can schedule them at times that work with your calendar, early morning, afternoon, you name it. So to schedule your part two session, again, simply scan the QR codes or email us at part2@swserve.com, and then we'll send you a link. And now, Ed, back to you.
Thanks very much, Dan. Okay, so I'm going to pick up where I left off. We talked about the FEGLI basic insurance amount. I want to talk a little bit now about the optional coverages. There are three optional coverages. Option A, standard life insurance, it's a flat $10,000. Unlike the basic insurance amount, in which employees pay 2/3 of the premium cost and their agencies pay the 1/3, the agencies do not contribute anything to the cost of the optional coverages, including Option A, standard, flat $10,000, premiums paid entirely by enrollees, no government contribution. Okay, so that's a flat $10,000. Then Option B, what is Option B? It's the additional coverages. It's a multiple of your salary. What salary? Again, back to your current year SF50 salary. So again, the SF50 salary in the adjusted basic pay, which is in either box 12C or box 27C. Take that salary, current year salary, round it up to the next $1,000. So we take either, you have an option of getting 1, 2, 3, 4, or 5 times that salary. And just to give an example here, let's suppose federal employees this year, starting with the new leave year, got on average a 1% pay increase. So whatever their SF50 salary was last year on average, it went up by 1%. So they're going to get a 1% boost in their basic insurance amount as well as their additional coverage through Option B. So as an example, let's suppose we have an employee whose SF50 salary, adjusted basic pay, is $121,600, $121,600. So what would be their basic insurance amount? Or you take $121,600, round it up to the next $1,000, that's $122,000. So their basic insurance amount would be $122,000 plus $2,000, or $124,000. Their Option B coverage would be, we take the $121,600, round it up to the next $1,000, $122,000, add $1,000, and then that employee either has 1 times, 2 times, 3 times, 4 times, or 5 times that $122,000. I want to show you this chart here. This chart here shows you the cost of the optional coverages for those who decided to enroll in it. Again, here let's look at Option A and Option B. We haven't done Option C yet. Well, here Option A, this is the monthly cost. If you want to get the biweekly cost, it's roughly half of that. So if you were an employee and enrolled in Option A and you're younger than 40, you're paying 43 cents per month. When you get to age 40, and through age 44, it goes up to 65 cents per month. If you go up at 45, it goes up. In other words, these are what they call age brackets here. But please look at Option B here. This is those different coverages. Someone has 1, 2, 3, 4, 5 times their SF50 salary as adjusted. When you're younger than 40, you're paying a little over 3 cents. They're a little over 4 cents per $1,000 of coverage. A little over $4,000 of coverage. So, and then when you get to age 45, it goes up to about 6.5 cents per $1,000 of coverage. Then you get to 45, it doubles. These are the age brackets. Note these age brackets here. Go up to, and then you go to age, when you get to age 50 to age 54, it almost doubles. It's almost 24 cents per $1,000 of coverage. Look what happens now when you go from age 59 to age 60. It more than doubles. Look what happens when you get 65. Look at it. You can see Option B can be expensive when you get up there. You get past your 55th birthday. This is the cost per $1,000. So suppose we have an employee. Go back to the example here. Suppose we have an employee who has a salary. Let's say they're turning 55 years old this year. They're turning 55 years old, and they got 5 times their SF50 salary. So they're, as adjusted, 121,600. Round up to the next 1,000 is 122,000 plus $1,000. So that brings them up to $123,000. And they got 5 times that. 5 times that. They got multiples of 5. 5 times $122,000 is $610,000 of life insurance. They're going to turn 55 years old. How much is going to be the cost? How much will be the cost per month? We take $610, because they have $610,000, multiply that 610 times 0.39. That's $237.90 per month times 12. Times 12. That's $2,854.80 per year. Ladies and gentlemen, that is expensive life insurance. That's why I was saying it gets very expensive. It gets very, very expensive as one gets older. That's option B. And look what happens when you don't want to know what happens when they get to age 60. It gets way up there in costs. So that's why a lot of employees, when they get close to retirement and they paid off that mortgage, they tend to get rid of option B, because of the cost. And finally, we have option C. Option C provides family coverage for a spouse and eligible dependent children. You get 1, 2, 3, 4, or 5 multiples for a spouse of $5,000. And if you have children, they got to be under the age of 22. Each child can get 1, 2, 3, 4, or 5 multiples of $2,500 for each child. So let's say we have an employee who has a spouse and let's say 3 children. All right. So they want to have 5 multiples for the spouse and for the children. So spouse will have $25,000 of life insurance coverage, and each child will have 5 times $2,500 of coverage. So that's $12,500 for each child. That's life insurance. Well, if you go to the chart here, what you're paying for is the number of multiples. So my example here, a spouse is getting 5 multiples and 3 children getting 5 multiples. That's a total of 20 multiples. What's going to be the cost? The numbers here represent the cost per multiple given their age. So if the employee is under age 35, they're paying for 20 multiples. That's 20 times 0.433, which is $8.66 per month. All right. But then look what happens. Oh, by the way, the age here is not the age of the spouse or child. It's the age of the employee. So if the employee is under age 35, that's the 20 times 0.433. When the employee becomes age 35, it goes up to 52 cents per multiple. So that's 20 times 0.52. When they get to age 40, it goes up to each multiple. 20 will be multiplied by 0.802. That's like $16. As you can see, it goes up. Keep in mind that when a child turns age 22, they are no longer insured. Again, option C is family coverage, and it's based on the age of the employee, not on the age of the spouse. So if someone has a younger spouse, they said, and definitely children are younger than the employee, it's going to be based on the child's age. It's not, in my opinion, a very good deal, So, but it's there if you want to take it. All right. Okay. So let's do an example here. How much all this is going to cost. There's something I want to make I want to recommend after we go through this analysis in terms of when you buy term life insurance. We have an employee. Her name is Mary. She's 55 years old. She's a federal employee with a current SF50 salary of $62,045. She currently has the basic insurance. Again, what is the basic insurance called? The basic insurance amount, BIA for short. The basic insurance amount is the employee's current SF50 salary. So with Mary, that's $62,045, rounded up to the next $1,000. So that's $63,000. Add $2,000. So Mary's basic insurance amount is $65,000. She has option A, that's $10,000, and she has option B, which is 2 times her salary. Her SF50 salary adjusted. So what is her adjusted SF50 salary for option B? Take her salary, $62,045, round it up to the next $1,000, which is $63,000, and then multiply that by 2. So that's $63,000 times 2, which is $126,000. So what is Mary paying for all of her life insurance? All right. Take the $62,045, round up to the next thousand, that's $63,000 or $63,000, which is $65,000. Again, this is her basic insurance amount. The $62,045 rounded up to the next thousand, $63,000 plus $2,000, which is $65,000. What is the cost? How much is Mary paying for her basic insurance amount? She's paying 16 cents per pay date times $1,000 of coverage, which equals 16 cents times 65, because she has $65,000 of coverage, times 26 pay dates. That comes out to be $270.40 per year. What is the option A cost? It's $2 per pay period times 26 pay periods, which is $52 a year. How much is option B costing, given the fact that she's 55 years old? It's 18 cents per $1,000 of coverage. Her coverage is $126,000. So 18 cents times 0.18 times 26 is $589.68. Mary's total cost. What is Mary's total cost for the year? Let's add it up. We take $270.40 plus $52 plus $589.68. That's a total of $912.08. That's what she's paying per year for FEGLI. And what is her total coverage? What is her total amount of life insurance coverage? $65,000 plus $10,000. That's option A. That's the $64,000 basic insurance amount plus $10,000 option A plus $126,000 option B for a total of $201,000. Now here's what I want you to note. What is Mary's cost per $1,000 of coverage? It's $912.08 right here, divided by how many $1,000 of coverage? She has $201,000 of coverage. So the cost per $1,000 is $4.54. Is that expensive? If Mary is healthy, I would say yes, it is expensive. So what am I recommending Mary do? If Mary came to me and said, hey, I'd like to pay less for life insurance, what should I do? My recommendation is that you contact a life insurance broker or a life insurance agent, preferably a broker. The difference between a life insurance broker and a life insurance agent is that a life insurance agent works for an insurance company. They're an agent of the company. A broker does not work for a life insurance company. It works for a client. The agent, the broker, when you contact a broker and say, Mary says, I need a life insurance policy, and could you help me find a life insurance policy? And the broker will take all the information of what life insurance do you need, for how long do you need it? How long do you need it? And then we'll do a search with various life insurance companies. And here's what Mary would say. You know, I got 15 years left of my mortgage. I'm 55 years old. After that, I don't think I need life insurance anymore. I just want to have enough to cover my mortgage. How much is left on your mortgage? Probably about about $120,000. So the agent, the broker would say, okay, let's search for a policy that costs a policy that $200,000, a 15-year term policy, 15-year term. In my opinion, it should not be a 15-year term policy. It should be a 15-year level term policy. Level term means the premiums do not go up anytime during the 15-year period. They stay the same. And Mary said, well, what happens if I don't need the policy? Suppose I pay off my mortgage by the time I'm 65. Then you don't need it at all. You can stop paying. You had no more life insurance. But the bottom line is that Mary should say to the broker, I want you to find me a 15-year level term policy in which the cost per $1,000 of coverage is much less than $4.54. And if the broker really wants to earn that commission, the broker is going to do that. You make that broker work. Make that broker work. This is what I mean, that you don't have to, you don't have to underpay. You definitely should not overpay when it comes to your life insurance needs. FEGLI, in my opinion, is good for individuals who could not qualify to get the best rates on an individual policy. But with the same rates, people ask me, why is it that everybody pays the same premiums when it comes to FEGLI? Because I think it's Metropolitan Life Insurance Company. They have a pool of employees. They have employees who are in their 70s and 80s. They have employees who are in their 20s and 30s. They have employees who are smokers and have employees who are non-smokers. They have employees who have had heart problems throughout their life. Everybody's put in one pot in terms of determine the premiums. Males, females, makes no difference. And Metropolitan Life Insurance, like any other insurance company, wants to make money. So they set the premium rates accordingly. So again, you can do better. I just want to mention something else. That it's in my experience over the years, that when you see what you're paying for FEGLI, and you see it every 2 weeks, if you look on your leave-it earnings statement, what you're paying for FEGLI. My experience is employees do not realize what they're paying, and in some cases they're paying too much. If you do pursue this Part 2 meeting, if you've never done a Part 2 meeting, you should bring in a leave-in earnings statement and ask the serving those representatives, what am I paying for FEGLI? What are all these codes? What does this all mean? It's on your leave-in earnings statement, and your serving those representative can help you interpret what these codes are and what you're paying. You can do better. You can do better in many cases. All right. So now let's talk about carrying life insurance into retirement. If we have an employee who's had FEGLI. Question is, can that employee carry their life insurance into retirement? And the answer is yes, but under the following conditions. They must, here, condition number 1, they have to retire under what's called an immediate retirement, as opposed to a deferred retirement. So let me explain the difference between immediate retirement and deferred retirement. Immediate retirement means whether you are a CSRS employee or a FERS employee, that you met the following 2 requirements in order to retire immediate retirement. Number 1, you've reached a minimum age to retire, and you have the minimum number of years of service. Example, a FERS employee who has reached his or her minimum retirement age. What is minimum retirement age? Any age between 55 to 57, depending on what year you're born. And two, you have at least 30 years of federal service, what's called credible federal service. So I have a client, I do her taxes. She retired on December 31st, December 31st, 2025, with 32 years of federal service at the age of 58. 32 years of federal service at the age of 58. Her minimum retirement age was 56 years and 10 months. So she passed her minimum retirement age. She had more than 30 years of service. She retired December 31st. So she retired December 31st. When did her retirement become effective? Immediately. As of January 1st, 2026, she's going to get her first FERS annuity check dated February 1st, 2026. Now that's different than a deferred annuity. What is a deferred annuity? Well, an employee, CSRS or FERS, left federal service. They were forced to leave. Over the past year, unfortunately, employees have been forced to leave federal service. They weren't eligible to retire. So they left federal service, and all the money they had contributed to the FERS retirement or CSRS retirement system, they did not withdraw their contributions. They left it there. Well, when they reach a certain age, then they will get their annuity. It's called a deferred annuity. We talk about this during our monthly FERS webinar, CSRS webinar. It'll be recording. The point of a deferred retirement is that you have to wait to get your annuity, but also when you leave federal service before you're eligible to retire, you lose your FEGLI. You lose your FEGLI. You will not get that FEGLI back when your annuity starts. Under immediate retirement, you keep your FEGLI if you retire under immediate retirement. I didn't mention this earlier, but it's worth saying now. That's another disadvantage of a group life insurance policy like FEGLI. When you leave the group, you leave your life insurance. You leave it behind. Okay. All right. So that's. And then there's something also under FERS, something called the MRA plus 10 immediate retirement, in which you get a reduced annuity, but that would also qualify for you to keep your FEGLI. And there's also something called postponed retirement under FERS, in which under the postponed retirement, you're a FERS employee, you reached your MRA, a little older, but you don't have enough years of service to retire without having your annuity reduced because you're under age 62. Well, in that case, in order to avoid having a reduction to your annuity, you postpone the start of your annuity to age 62 or 60 if you have at least 20 years of service when you leave. Can you keep your FEGLI there? Yeah, in that case, if you postpone the start of your annuity, the answer is yes, but here's the problem. While you're postponing the start of your annuity, your FEGLI insurance will be suspended. It will be suspended. What does suspended mean? It means you're not insured because you're not paying any premiums. Why aren't you paying any premiums? Because you're not getting a paycheck, you're leaving federal service, you're waiting to get your annuity, and you're not getting an annuity check. So how are you going to pay your premiums? But it is possible that when your annuity starts, then your FEGLI life insurance will be reinstated. All right, that's the first requirement. Second part of, and you can keep all the parts of your insurance, okay? All the parts of insurance in retirement. That includes the basic insurance amount, the optional coverages. Keep in mind, though, with option C family coverage, I mentioned this earlier, say it again, that when a child turns 22, they are no longer covered under option C. You'll get a notice from the insurance company, as of this day, they'll probably to give you a couple months notice when your child, the month and day they turn 22, no more life insurance for your child. That's life insurance. I didn't say health insurance, it's life insurance. Okay? Look at the third bullet, because this is a biggie. You must have been insured under FEGLI for the 5-year period preceding retirement or since your first opportunity to enroll. Now, what does that mean? It means that if you've been enrolled in FEGLI all along, from the time you came into federal service to the day you retired, you met that 5-year rule. But suppose when you came into the government, you decided not to go into FEGLI, decided not to take it. You just said, no, I don't want the FEGLI basic. I'm not interested in the optional coverages. So when can you add FEGLI? When can you get it to FEGLI? One of two ways. One, a life event. What's an example of a life event? You got married. You had a child. You adopted a child. A spouse died. Yeah. You got divorced. Yeah. That's a life event. You can get into FEGLI. Okay? Get into FEGLI. Well, the other opportunity you get into FEGLI is that there's an open season. There's an open season. But I will tell you that FEGLI open seasons are rare. The last FEGLI open season was held between September 1st and September 30th, 2016. That's almost 10 years ago. The one before that was held between September 1st and September 30th, 2004. That was 12 years earlier than that. The one before that was 1999. The one before that was 1992. They don't hold them that often. So the point is that for the purposes of keeping the FEGLI in retirement, you must have been enrolled in FEGLI if you want to keep it in retirement for at least the last 5 years of your federal service, the 5-year period ending on the effective date of your retirement. My example, somebody retired on December 31st, 2025. What's the effective date of her retirement? January 1st, 2016. So if she was in FEGLI, I don't know if she was in FEGLI or not, but if she was in FEGLI and she wanted to keep her retirement, she must have been enrolled in FEGLI for the period, at least the period January 1st, 2021 through January 1st, 2026. That's a 5-year period. Okay? Another thing you could not have done, you didn't convert your FEGLI coverage to an individual policy. You have an option with FEGLI, is that if you find that the FEGLI is too expensive, the way it is, you're finding it too expensive, and you really can, or let's say you're going to be leaving federal service, like this past year, so many federal employees leaving federal service, and they're going to leave federal service, and they know they're going to lose their FEGLI coverage. They have the option of converting their FEGLI term life insurance to a whole life insurance policy. Metropolitan Life Insurance runs FEGLI is in charge of that. Now, this whole life insurance policy can be expensive. What is the advantage? It's guaranteed issue. You don't have to go for a medical exam. But it's going to be expensive. It's going to be expensive. So be aware of that. If you did that, then certainly you're not going to be able to keep the life insurance in retirement. All right. Let's go through the options in terms of if you're going to keep it for retirement, what the cost is going to be, what the cost is going to be in terms of in retirement. The cost, we've talked about the cost when you are an employee. So how much is FEGLI going to cost in retirement? Okay. And the best way to describe this is do an example. So here we have an employee who retired on October 31st, 2025. Their SF50 salary, it turned out to be $97,500. So what is their FEGLI basic coverage? Okay, we take the $97,500, round it up to the next 1,000. That's $98,000. We add $2,000, so that's a total of $100,000. That's their FEGLI basic coverage. Okay, we're going to talk about the FEGLI first, and then we talked about option A, B, and C. A, B, and C. The cost of your employee. We're going to talk about that separately now after we do the FEGLI basic insurance amount, the cost in retirement. Okay. Now, this employee retired on October 31st, 2025, was given a form. This is Form SF2818 to elect their FEGLI coverage for the retirement. I have SF50. I have this SF50 2818 form here on the screen. You know, here's the employee's name, fill it out. Here's the basic life insurance. Do you want to have basic life insurance in retirement if you are eligible? You say yes, yes, yes. Okay? And then it says that's question number 7. Question number is, what level do you want in retirement? Check only one box. We have 3 options here. 75% reduction, 50% reduction, or no reduction. So let's go back here again and see the option and see again what this employee has, because their FEGLI basic insurance amount is $100,000. That's the amount of their FEGLI basic life insurance on the day they retire. That's what they want to carry into retirement. So the question is, how much of the $100,000 do they want to keep in retirement? All of it? That's no reduction. 75% reduction? That would bring them down to $25,000. 50% reduction will bring them down to $50,000. So let's go through each election. All right. So the employee decides, if they decide they want to keep 100% of their coverage, 100% of the coverage, no reduction. Let's suppose the employee retired, I'm going to have right here age 62. Age 62. So what are they going to be paying per $1,000 of coverage? It says here between age 62, right here they retired at 62 until they turn, and between age 62 and let's say it's right here at 65, they're going to be paying per $1,000 of coverage $2.5967 per $1,000 of coverage. That's the cost per month. Do you remember earlier what I said the cost was when you are an employee? What is the cost for the FEGLI basic insurance amount? Remember 0.3467, 0.3467. That's 0.3467 cents per $1,000 of coverage. Here they're paying $2.5967. That is a 750% increase in cost. Here, the month before they retired, they were paying for $100,000 of coverage. They were paying $34 and 67 cents per month. Now they're retired. They're paying $259.60 per month for $100,000 coverage. Wow. That's a tremendous increase. A retiree, some of the retirees says, woo, I didn't know that. I don't know I can afford this. It's unaffordable. Are they stuck? No. I'll talk to them in what happens if they go to, they reduce their coverage, and they can. Okay? When they turn 65, they get a little bit of a break. The cost per $1,000 coverage goes down to $2.25 per $1,000 of coverage. So you would probably agree that keeping 100% of your FEGLI basic in retirement is basic insurance amount is probably not a good idea. All right. So let's go down to the second option, a 75% reduction. a 75% reduction. Now, what is this all about? Going back to the form SF, there we go. Here's the 75% reduction. Okay? The employee checks that box. They retired age 62. What are they paying for the FEGLI basic coverage? How much coverage they have? They have 100%. They have 100% coverage. That is $100,000. They have 100,000 coverage. It's costing them $34.3467 for $1,000 of coverage, $34.67 per month, the same as what they were paying when they were an employee. And that continues until they're 65. When they reach 65 right here, their coverage is being reduced by 2% per month. 2% of what? 2% of what they started with. So 2% of 100,000 is 98,000. So 1 month after their 65th birthday, they have $98,000 of life insurance, FEGLI basic life insurance, 98,000. The month after that, 96,000. The month after that, 94,000, 92,000. So after about a little less than 38 months, they have $25,000 of coverage. And what are they paying? What is their monthly premium? Nothing. No cost. This is free life insurance. So the point I want to make is that anybody who has had FEGLI all along, at least during the last 5 years of retirement, you would be foolish to drop it in retirement, because when you reach your 65th birthday, this is after you retired, or if you retire after age 65, at that point, the reduction starts right away at age 65. Or at age 65, if you retire before 65, the month after you retire, the reduction starts right away. If you're retired at 65 or older, and you have free life insurance. This is the 75% reduction. It's free life insurance. So going back to our example, Mary, I would tell Mary, oh yeah, you can get another policy, that 15-year term, but don't give up FEGLI, because when you turn 65, it's going to be free. It's going to be free. It's going to reduce, but you'll have free life insurance. And the other option is the 50% reduction for FEGLI. Again, here we go. Is this a good deal? I don't think so. Because you're up until 65, you're paying this. Up until age 65, you're paying $1.0967 for $1,000 of coverage. You're paying more than you did when you were an employee, basically about 3 times as much. And then when you reach 65, they reduce you down to 75 cents per thousand. Again, that's twice as much, and you have less coverage. I don't think it's a good deal. A couple more things here. I said that the person who decided to keep 100% and then they regret it. They said, I can't afford it. Can they reduce it in retirement? The answer is yes. You could always reduce it. You can do that at any time. Anytime you can reduce, we're talking about in retirement. But don't do the following. Drop it. If you drop your FEGLI coverage and you're a retiree, you cannot get back in. You can only reduce it. You cannot increase it. If you did the 75%, oops, I'm losing. You find out you lost, you're losing, you need more life insurance coverage. You cannot increase it. If you did the 75% reduction, 75% reduction, you can't go back to 100%. If you did the 100%, or the 50% reduction, you can't go back to 100%. You only can decrease, you cannot increase. With the option A, good news, if you've had it for the 5 years before you retire, then starting at age 65, it also is free, because they're reducing it by 2% per month, $200. So if you had option A, your recommendation is keep it, because eventually it's going to be free. You'll end up with $2,500 of option A. Option B, I'm telling you, it's very expensive. As you get, I showed you the chart there, how much option B is. If you need to keep the FEGLI up to a certain, keep the FEGLI option B, you can make the election. Again, going back here, here you go, option B. You can have this option number of no reduction multiples, number of full reduction multiples. And go back here. If you elect a reduction, a 2% reduction per month for 50 months, it'll be free starting at age 65. You're reducing the amount of option B over a period of time, 2% per month. So after a little over 4 years, you'll have no option B. It'll be free. Okay. And the same thing with option C. All right. Please make sure you've named a beneficiary of your FEGLI life insurance. I'll give you the form here. The form is SF2823. SF2823. Make sure you have a beneficiary. Recommendation that if you have primary beneficiaries, and anybody can be beneficiary, a spouse, a child, niece, nephew, friend, could be a charity, but name someone as primary beneficiaries. You can name any number. I think the limit's 10, but also name a contingent beneficiary. A contingent beneficiary. For each primary beneficiary, name a contingent beneficiary. Make sure your beneficiaries are up to date. Up to date. Who can be named? And usually, especially if you when you got your FEGLI, you named your spouse as beneficiary, but you since have divorced that spouse. You better change that beneficiary, because the courts have said, when it comes to a life insurance policy, an IRA, a pension plan, I would say a 401k plan, TSP, it makes no difference. If you named a former spouse as beneficiary, you since got remarried, you pass away, you never updated that beneficiary form, your former spouse is going to get the money. It's going to get the money. You don't want that to happen. Also, make sure that whoever you named as beneficiary is still alive. This is a true story. There was an individual who came into the government around the same time I did in the early 1970s. He was single, ran out of college. He signed up for FEGLI, and who did he name as beneficiary? Mom and dad, of course, each 50%. Well, he subsequently got married, wife, 3 children. In 2004, he died of a stroke with $600,000 of life insurance to his name. Who was the beneficiary? He never updated that beneficiary form, mom and dad being 50% beneficiaries. Both had passed away. So what happened? They had to reopen the estate. His wife and 3 children eventually got the life insurance money from FEGLI, but at a big delay and a big cost to reopen the estate. So again, please make sure your beneficiaries are up to date and name contingent beneficiaries for each primary one. All right. Term life insurance is life insurance for a limited period of time. No refund or premiums paid at the end of the term unless a return of premium term life insurance is purchased. There is no cash value. Individual or group policy. FEGLI is a group term policy. The periodic cost of term life generally increases as the insured ages. Most insurance companies offer annual renewable term, which means that as the insured ages, premiums increase. Term life insurance is life insurance for a limited period of time, 10, 15, 20, 25, or 30 years. There is no refund or premium paid at the end of the term. It builds up no cash value. Okay? The periodic cost of term life insurance increases as the insured ages unless the policy purchases level term life insurance. Again, level term life insurance comes in denominations of 10 years, 15 years, 20 years, 25, 30. Some companies now are offering 40-year level term policies in which you pay the same premiums throughout the time that you own the policy. Even as your health deteriorates and makes the difference, you don't have to prove insurability, you pay the same premium. With annual renewable term, the premiums the person who buys the policy will be lower compared to someone who is the same age who buys level term. But here's the problem with annual renewable term. With annual renewable term, as you get older, the insurance company has the right to raise your premiums. Why? Because you got sicker? No, because you got older. As you get older, get closer to death, the insurance company has to, they're taking a higher risk, they're going to charge more premiums. Decreasing term. It's another type of term life insurance. Decreasing term life insurance were pushed by mortgage companies. At one time, I don't know if they still do this, mortgage companies used to have life insurance people sitting in their offices. The idea of being a mortgage, when you take out a mortgage, you pay down your mortgage over a period of time, 20 years, 25, 30 years. In the early years of the mortgage, you're paying mostly, your so-called PITI, principal, interest, taxes, insurance. Just talk about the principal and interest. The early years, you're paying mostly interest and little principal. As time goes by, it reverses. You pay more principal than interest. Well, what happens if you die while in the middle of your mortgage? Well, there's going to be a certain amount of principal left that has to be paid. Somebody's got to pay it. And the idea being that if you take out a life insurance policy, whatever is left on the mortgage, if you have a sufficient amount of life insurance, the life insurance proceeds will be paid out to pay off the balance of the mortgage. The idea being with a decreasing term life insurance policy is that you pay, with a decreasing term life insurance policy, you pay the same premium throughout the term of the policy. A 30-year decreasing term policy, you pay the same premium, but what's being reduced? The amount of your life insurance coverage. According to what? According to what your mortgage balance is. It decreases down according to the amount of your life insurance coverage decreases according to how your life insurance coverage is decreasing. I've seen some cases where it doesn't work that way. It seems like the life insurance coverage the coverage is decreasing at a faster rate according to how you're paying down your mortgage. And lastly, we have return of premium term life insurance. Return. I'm sure you may have seen these advertisements in which if you outlive your life insurance, but you bought a 20-year term, 30-year term life insurance policy, and you outlived it. That is, you paid 20 years of premiums, the policy's over. 30-year term life insurance policy, you pay 30 years of premium, policy's over. And you say, gee, I paid all that money. I got nothing to show for it. Well, thank God you lived. Well, the insurance companies have come up with an idea that if you outlive the policy, they will return your premiums that you paid. They'll give you all your premiums back. Here's the catch, though. The premiums you're going to pay, though, for that are going to be higher compared to, let's say you bought a level term policy. Let me give you an example. Someone took out qualified for a 20-year term life insurance policy. They're paying $1,000 a year for 20 years. So after 20 years, they paid a total of 20 years times $1,000 per year, or $20,000. Policy's over. If they had bought a return of premium life insurance policy, a 20-year return of premium life insurance policy, their premiums would be $2,000 a year. So after 20 years, they paid $40,000. And how much would they get back from this policy? $20,000. Now they got back had it been just a regular term policy. Not a good deal. Stick to level term. That's the recommendation. All right, Dan, I think it's time for the questions. Want to go through those?
Thanks, Ed. Once again, folks, here's an example of some of the questions that we encounter and have answered within the part 2 sessions. So that's sort of to get your juices flowing here. Before Ed continues, though, I do want to share something with you. I want to begin by saying thank you. Why? We know that many of you found this training because a friend or colleague told you about us. And that is really important. Again, why? What helps us provide these trainings at no cost and allows folks like you to access them whenever they need. By sharing the training with others, you're helping us get the word out, and you're helping your friends get a better understanding of their benefits. One of the things we know, Ed's touched on it, HR and retirement specialists have been stretched really thin for years, and last year just made it worse, and simply can't provide this type of comprehensive education for everybody. So I'm asking for your help. I would like you to think right now of someone who should watch this training and then let them know about it. Simply forward the link to this training or send them to stwserve.com, and they can access all of our on-demand trainings as well as our other resources. We're asking each person to reach just one person. So thank you for helping us spread the word about what we hope is a valuable resource for federal employees. And Ed, back to you. Take us home, sir.
Okay, great. Thanks, Dan. All right. Talk a little about cash value permanent life insurance. Most of these policies provide what's called lifelong protection. You can cancel or surrender the policy totally or partially. You can receive the cash value as a lump sum, fully taxable. If surrendered in the early years, very little or no cash value. If one cannot afford to continue paying premiums or wants to cancel the policy, then the policy owner can use accumulated cash value to continue insurance for a specified time. You can have lesser amount of protection of covering insured for a lifetime. Can usually borrow from the cash value of the policy as collateral. A loan not dependent on credit checks. This is if you have to borrow and you wouldn't qualify for, let's say, a commercial loan. This is one way you can take money out. And do you get the money? A loan must be paid back with interest, or beneficiaries will receive a reduced death benefit. I'm just going through the different types of policies here. Again, I'm not going to spend a lot of time on this. Again, I'm not a big fan of these. I don't recommend this. I don't generally recommend cash value life insurance policies unless it has there's a very important reason to buy cash value. And one reason would be you've used every way possible to, you've done everything you can to save for retirement, maximize your TSP, IRAs, everything. And you're using the life insurance as a possible way of paying for, let's say, death taxes or something like that, estate taxes. There are some reasons that people buy total life insurance policies. Okay. All right, let's move on. Let's move on and talk about the tax consequences when it comes to life insurance. Premiums paid on individual life insurance policies are generally not deductible for income tax purposes. When you pay your premiums for FEGLI via payroll deduction, or you have an individual life insurance policy, a term policy, or cash value policy, the premiums you pay are not deductible. Is there any way that premiums that you pay for a life insurance policy can be deductible? Here are two possibilities. If you own an individual life insurance policy and your only beneficiary is a nonprofit organization, such as a church, a mosque, a synagogue, and you itemize, that is, you file Schedule A, then the premiums that you pay for that policy, you can include as a charitable donation. If anybody else is named a beneficiary, the nonprofit organization is a 50% beneficiary and an individual is the other 50%, then it's not going to be deductible. The beneficiary has to be the sole beneficiary. That's one way. That's one way your premiums may be deductible. The other way is that if your premiums you're paying are considered alimony and your divorce settlement was stated before January 1st, 2019, then the premiums you pay are for that divorce. Why you're paying, what the divorce settlement says that you must take out a life insurance policy on yourself as part of the divorce settlement. Now, why would that happen? Well, your former spouse says, listen, you're paying me alimony, you're paying me child support. What happens if you die? Then no more alimony is going to be paid. No more child support. It's not going to come out of your estate. So I have to protect myself. This is your former spouse. So as part of this thing, you know, I want you to take out $1 million life insurance policy, and I'm going to be the beneficiary. That money will be used to pay me alimony and to pay for child support. Well, the premiums you pay for the alimony portion would be deductible. But again, this is only for divorce settlements that occurred before January 1st, 2019. The Tax Cuts and Jobs Act of 2017 said effective January 1st, 2019, alimony is no longer deductible to the payer and no longer will be taxable to the payee. Okay? Insurance proceeds paid from a life insurance policy due to insured's death are excludable from the gross income of beneficiaries. Once again, any life insurance proceeds paid out to the beneficiaries of a term life insurance policy, a cash-free life insurance policy, are excludable from the gross income of beneficiaries. Here's something that some federal employees are not aware of. Remember I was talking about FEGLI, the basic insurance amount. Employees pay 2/3 of the premium costs, and their agencies, the federal government, pays the other 1/3 cost. Let's read what it says here. Employer-sponsored life insurance, such as FEGLI, can provide an employee with up to $50,000 of group term life insurance without any tax consequences. The taxable value of employee-sponsored insurance in excess of $50,000 is calculated from IRS tables. Now, how are you going to know how much of the employer or your agency contribution to your FEGLI basic insurance amount is taxable? Look at your W-2 statement. Your 2025 W-2s should be issued sometime during January 2036. And if you are enrolled in FEGLI, please look on your 2025 W-2, or if you're looking for an earlier hearing, maybe you got your 2024 W-2, look at it. Go to box 12C, C as in Charles. And the C, if you go to the code for the W-2, the C stands for the cost of group sponsored life insurance. And there'll be a dollar amount in there, like $22, something like that. And that $22 in box 12C is added to your taxable wages. You pay federal tax, you pay state tax, and it's also included in your Social Security wages and your Medicare wages. Okay. And here's the calculation. Another thing you should be aware of. Yes, I said that when the life insurance proceeds are paid out from a term or cash value life insurance policy, the proceeds paid out to the beneficiaries is not subject to federal and state income tax. However, a life insurance policy includes FEGLI or an individual life insurance policy owned by the insured is included in their gross estate. We have a federal estate tax in this country. When you pass away, if you were to pass away in 2026, and you have an estate over $30 million, if you have an estate that exceeds $15 million, it's $30 million for a couple, then your estate is subject to federal estate tax. Now, I don't think there's a chance unless people have a $30 million estate, okay? But here's the problem. There are 12 states in this country, in the District of Columbia, that have their own estate tax. And their thresholds are much lower as far as when the state estate tax kicks in. For example, Oregon has a $1 million estate tax, a $1 million threshold for state estate taxes. Maryland, $5 million. Ladies and gentlemen, it does not take much to come up with an estate that's more than a couple of $1 million. I mean, think what's included in your estate. You're talking about real estate. You own a house. You might have a second home, you might have a rental property. That could easily be a couple $1 million right there. Life insurance policy, somebody owns $1 million life insurance. There you go. There you go. Everything you own and the life insurance policy. Now, there are ways you can get around this. You could assign ownership of your life insurance, gift it out. Someone else will be the owner. You don't change the beneficiary. Somebody owns your policy. You don't own it. So if this does affect you, you think you're going to be subject to an estate tax, you should talk to an estate attorney. Okay? Okay. Make some suggestions. How we talked about using a life insurance agent or broker. Here are some suggestions about, in terms of choosing a licensed life insurance agent or broker. Some of the things the agent or broker should do, what they're able to do, some warning signs. Choosing a licensed life insurance agent or broker. First of all, it makes no difference where you live. Live in any state, District of Columbia. Someone's going to come to your house, come to your condo, come to your apartment to sell life insurance. They have to be licensed in the state that you live in or district to sell life insurance. For example, I live in Maryland. I have a Maryland insurance license. When I was selling life insurance policies, I had clients in D.C., District of Columbia, Virginia, even Pennsylvania. I got what is called a non-resident license to sell those states. It makes no difference where I'm located. It's where the client's located. And please, when you meet with this person, I would ask this person, can I please see your license? I want to see your license. Okay? Okay? How do you find it? How do you find such individuals? You collect recommendations from family and friends. You contact your state insurance commission. Every state has a state insurance commission, and they have a list of all licensed brokers and agents. A competent and licensed agent or broker will be able to provide information and advice on coverage options and costs. Be able to do a fair comparison of costs with policies equivalent to FEGLI. That person, if you are enrolled in FEGLI and you want to be able to pay less for your life insurance, that agent or broker should be totally familiar with FEGLI. And if they're not, they want to sell something, then they say, well, you go read the insurance manual. Go look at the FEGLI manual. Go to the website there. It's all there. It's on the website. The FEGLI Life Insurance OPM has its website. You can download the whole thing, read it, and then when you're totally familiar with it, come back to me and we'll talk. Okay? I would be very careful if an agent or broker sells insurance as a side business. Okay? If they don't want to show their insurance credentials and background, forget it. They're hiding something. You may want to ask your state insurance commission if this particular person has any marks against them. When I say marks, maybe they got disciplined for doing something there. Maybe they got fined. They were temporarily suspended. The state insurance commission will. Every state has a state insurance commission. Also, when the person says, "Yeah, I'll be happy," you find somebody like, say to the person, "Okay, great. Could you give me 3 references, 3 people, 3 to 5 people you helped? Would you give me their email addresses? Give me their phone numbers so I can call them up to see, what type of what experience they had with you?" Don't be hesitant. Don't be hesitant about this. A good life insurance agent or broker should gather information about potential insurance financial assets and goals, should discuss potential life insurance options and set reasonable financial goals, should be able to explain various types of life insurance policies. Choosing a life insurance company, you should check out the financial condition and rating. In my opinion, I would always do this when I would meet a client. If I would recommend any particular insurance company, I would show the person what their rating is. Insurance companies are rated. There's Dun & Bradstreet, there's S&P, there's the Standard & Poor's, and the ratings go everywhere from AAA, which is the best, all the way down to D, which is deficient. You don't want to get a policy with a company that has less than a double A rating, in my opinion. Why? Because if you're talking about years, then you might be buying a 30-year policy, a life insurance policy. You want to make sure that company's in good financial standing. You don't want them to go under or be taken over. Okay. To purchase a policy from a company of one's resident state, the insurance company must be licensed to sell in that state. Not all insurance companies can sell in every state. The state insurance company has to approve an insurance company to sell in their state. Okay. And finally, I want to go through avoiding the biggest errors when it comes to purchasing and owning life insurance. These are the biggest errors that individuals make. Here it is. Not listed in any order of importance, but these are the mistakes I've usually come across. Naming one's estate as beneficiary. For example, you put in your will, someone's going to be the beneficiary of life insurance. That's the worst thing you could do. You don't want a will is not substitute for a beneficiary form. So you name an individual, okay? Because if you name your estate as a beneficiary, the gross proceeds will be subject to state inheritance taxes. There are 6 states in this country of inheritance taxes. And make sure your beneficiary forms, in this case, for FEGLI, SF-222, are up to date, okay? Failure to name, well, I say at least one contingent beneficiary. For each primary beneficiary, you name at least one contingent beneficiary. Why? Because if a beneficiary predeceases you, the policy owner, and there's no contingent, what's going to happen? If you don't have any other beneficiaries, then it'll go into your estate, which is right back where we are at number 1. Number 3, not reviewing life insurance policy during the last 3 years, particularly one's beneficiary designation. 4, purchasing the wrong type of life insurance. You bought a permanent life insurance policy versus a term insurance, or vice versa. My opinion, most federal employees do not need permanent life insurance. Term is fine. The amount of insurance is inadequate given one's needs. Will the survivors be able to live and pay for their needs, food and clothing? This goes back to what we said earlier about how to calculate the right amount of life insurance. Using this multiple salary income 8 to 10 times, in my opinion, is insufficient. It has to be more detailed. And again, this is where a good life insurance broker or agent will do his or her homework, will earn their commission. They run the numbers. Bottom line is, will the amount of life insurance be sufficient to help your survivors pay off all debts and other expenses for the rest of their lives? Number 6, all the insurance is owned by the insured. And this comes into this estate tax. That if you know you're going to be subject to some type of estate tax, federal, state, both, there are ways that you can get the life insurance out of your name. Somebody owns it. It will not be included in your estate. Again, you need to talk to an estate lawyer about that. Number 7, not realizing FEGLI insurance becomes more expensive during retirement. More expensive, especially after age 60. This is option B. Encourage to check out private life insurance, term or permanent insurance within 5 to 10 years of retirement. Premiums will be less expensive than older applicants. You have a better chance medically of qualifying at a younger age. Number 8, understanding the disadvantages of private insurance as a supplement or substitute for survivor benefits. I'm not going to have time to talk about this, but when you retire from federal service and you are a married person, you have, this option of giving what's called a spousal survivor annuity to your spouse. Maximum survivor benefit is 50%, less than maximum 25%. Now, there are people in the insurance industry who say, well, this survivor benefit, federal benefit is very good, but you can really do better with life insurance. Well, that's not necessarily true. It's called pension maximization. Why do they say pension maximization? Because in order to give a survivor benefit to one person, let's say your spouse, you're going to take a reduction in your annuity to get that survivor benefit. So some insurance people say, well, take the money that you would be deducted from your annuity to pay for this survivor benefit and take that money and buy a life insurance policy on yourself And that so when you die, your annuity is going to stop, but all that life insurance proceeds will be enough to pay more than a survivor benefit. Well, that's not necessarily true. Also, the cheapest form of life insurance is term life insurance. If you outlive that policy in retirement, then your spouse is going to get nothing. And the other problem is, and this is really important, that if your spouse is on your federal employee health insurance and you want to make sure they maintain that health insurance in retirement after you pass away, you must give your spouse a survivor annuity. You must. Because if you don't give them a survivor annuity, they're on your policy. When you die, they're going to lose that health insurance. That's the last thing you want to do for your spouse. Just a couple of things. Over the years, most private insurance have decreased their premium rates. People are living longer today. Insurance companies are getting more sophisticated now how they determine premiums. Again, I would definitely make sure before you meet with an insurance person that you do a little bit of homework. When you hear about, you see some companies that you're interested in, you can do some homework yourself, looking into the ratings, AM Best, Moody's Investment Services, Standard & Poor's. I would look at your individual and family medical history. I would review your lifestyle, travel, hazardous hobbies, legal problems with respect to owning life insurance in retirement, and so how much life insurance coverage is needed. Okay. Before you cancel or reduce FEGLI, please do me a favor. If you definitely want to buy an individual life insurance policy and you're thinking about canceling, reducing FEGLI, do not cancel FEGLI, do not reduce FEGLI until you've been approved for a private policy. You don't do that. Until that you get that, you have that private policy in hand. Do not do anything with FEGLI. Don't do anything with FEGLI. Okay. Remember what I said earlier in terms of when you are retired, when you are a federal retiree. If you cancel, if you get out of FEGLI, you cannot get back in. If you are an employee, can you get back in? Yeah, either if it's a life event or an open season. But open season are not held that often. There's no guarantee of qualifying for individual life insurance. Very few, if any, insurance companies offer term insurance after a certain age, I should say. Okay, Dan, I've come to the end here, so let's wrap this up.
Yes, sir. Folks, working with that as long as I have, I know exactly what it feels like when you're drinking from that fire hose of information. So one of the biggest things we do in part 2 is help you process all of it. So I'm just going to take a quick moment to reiterate the difference between part 1 and part 2. So, for example, regarding TSP, part 1 would be, what are the rules? How much can you put in? How does the match work? Part 2, on the other hand, how might you want to be maximizing your TSP? What's a good strategy for you? Regarding your pension, part 1, how's the pension work? What's the formula? What's the eligibility criteria? Part 2, what's your pension going to look like? And what does it look like if you work a little longer or even a little shorter? Regarding Social Security, what are the rules around when you can draw? That's part 1. Part 2, what's the best strategy for you and your family as far as when to draw? So again, on our screens, I think that'll pull one up towards the end, you can see our QR code that you can scan for requesting a part 2, or you can email us at part2@swserve.com. I will caution you of one thing. These things are incredibly popular, especially after what you all have been through in the last year. So if you don't see something in the current week that works for you, look out into the next one. We have open up calendars to the maximum. I've even come off the bench, so you might even be stuck with me. So by all means, take a moment to look at that. We created this on-demand format because you asked for flexible, accessible training that fits your schedule. That's what we do at Serving Those Who Serve. We listen to what federal employees need, and we do our best to respond. So whether you're thinking about retirement, or you're getting close to thinking about retirement, or you're getting close to thinking about retirement, wherever you are, we're here to help you understand your benefits and make more informed choices. Ed, thank you for another comprehensive training session. And thanks to everyone who's watching now for taking the time to do this. Check out our website, swserve.com, for more on-demand trainings. Ed's FedZone columns are dynamite. FedLife and Fed15 podcasts, great resources. And remember, this is available for you to watch anytime you need. So if you didn't get through the whole thing, don't worry about it. Just come back to it. And when you're ready for personalized guidance on your specific situation, we're here for your part 2 session. So thank you for being part of the federal community. Thank you for your service to everyone. And we'll see you next time.